there is a company in the personal care space which we funded and was doing about a top line of about say 3.5 crores per month. Profitable company having gross margins of more than 60-70%, say a contribution margin of about 8 to 10% at a post marketing and other expenses. So doing reasonably well. Founders are very young but very smart enough to understand that they may not raise equity or even a venture debt giving warrants upfront today, because they were very clear that if they reach 10 CR monthly run rate of a revenue, they'll be able to attract a very higher valuation. So these founders in fact had already offered some strategic investors of some 3x net revenue multiple for their acquisition. They were able to grow this revenue from 3.5 to 10 crores in a span of 18 months. This sounds very crazy, but they were very clear in terms of the market which they want to reach out. They already had right margin structure and the channels. So they raised money 2 times from us and quickly repaid, then raised again. So the cost of debt they didn't bother, but they were very clear that the opportunity cost today of not reaching that milestone in the next 18-24 months was significantly higher compared to what they're paying today. So largely a D2C company needs money for financing their inventory for the receivables. It's a D2C, so you don't require a lot of receivable financing. Many D2C brands do sell to platforms like a Flipkart or an Amazon equivalent, etc. So there is a little bit of receivables or credit involved. However, inventory financing and inventory receivables and payables working capital remains the significant use cases. There is a lot of seasonality in the businesses depending on which industry you are. If you're let's say in the electronics or appliances category, Diwali is a big space. So many D2C businesses, they bulk up inventory prior to that. That is where D2C brand definitely should raise money for the working capital use cases. So D2C founders typically, if you have a predictable cash flow, you are a positive profitable company, they will typically go to a bank and try and get some sort of cash credit overdraft limit by giving certain collateral, because banks are the cheapest cost of capital and they as a regulated entity can give you the most flexibility if you're a profitable D2C brand. If they can't do that, then they try to go to certain NBFCs, right? Because they are at least pseudo banks or try and give you some better terms and pricing, etc. If they can't raise from NBFCs or banks and they have to resort to a VD sort of a lender, then you should ideally raise a longer term capital so your monthly outgo is lower. So for loss making D2C brands, the challenge again is that if you have decent runway, then you can able to raise money from fintechs or NBFCs very easily. When I say decent runway, that means at least 8 months of a runway. It will allow you to raise money. So for a loss making company, I think it is much more important to be prudent in terms of what are the structures of the debt which they're raising. It is better suited in the loss making company to raise in the smaller bits rather than a larger chunk to avoid a situation of a default. So that planning for a D2C loss making company should be very important. That where are you going to be using this money for working capital, or are you going to use money for your burn? This should be planned very carefully for such businesses. At a loss making company, I think you should really optimize for the tenure of this debt. It is very important to be able to plan the repayment of the debt which you're taking, and also planning your cash runway and the next equity round, and not doing any mismatch in terms of too short period. Otherwise, you might just end up paying a lot of interest cost to the lender itself and not actually putting it into the business.